In my 20s, I had a great experience. I lost $22,000 in a single trade. Not because I was dumb and not because I didn't work hard, but because I was playing chess while the market was playing poker. So the truth is that the strategies that have consistently made me profits after trading for over 3.5 decades are quite simple. And today I'll share them with you. So if you've ever felt like trading is just too complicated, stick with me for the next few minutes. Secret number one, defense before offense. Do you know the difference between a gambler and a trader? A gambler hopes and a trader plans. So for the first secret, I want to go in depth into risk management. And look, I get it. It sounds boring and you've probably heard about this somewhere else. But without what I'll tell you shortly, you won't be trading in 3 years. Heck, probably not even in 1 year. First up, the 5% rule. Never, and I mean never, risk more than 5% of your total account value on a single trade. If you've got a $10,000 account, the maximum you can lose on any one trade is $500. That's it. The 5% rule is like wearing a seatbelt. Boring, but it saves your life. Now, this doesn't mean you can only buy $500 worth of stock or options. It means your maximum potential loss, protected by your stop loss order, cannot exceed $500. This is because when you follow the 5% rule, you can be wrong 3 times in a row and you've only lost 15% of your account. You're still in the ball game. But if you're risking 10% or 20% per trade, after 3 losses, you're basically done. Once I watched a guy turn $250,000 into $3,000 in 1 week. He was risking 33% per trade. Don't be that guy. The 5% rule only works if you know how to calculate your position size correctly. Position sizing is how you make sure that the 5% limit is never breached. Here's the formula. Your position size equals your max loss divided by your stop loss distance. Quick example. $10,000 in your account means a $500 max loss. If you want to buy a stock or options and your stop loss is 50 cents below your entry, $500 divided by 50 cents is 100 shares. That's it. Lastly, you need to protect your profits. Here's a simple rule for you. Once a trade moves significantly in your favor, you need to protect those gains. You can take partial profits to lock in some of that money. You can also move your stop loss to break even, or even better, begin to use a trailing stop that follows price higher. But knowing how to protect your capital is only half the battle. You also need to know when to actually pull the trigger and enter the trades. And if you're getting value from this, hit that subscribe button. Every week, I'll be sharing new lessons to help you trade with clarity and confidence. Secret number 2, wait for the confluence. Now, you don't need 17 indicators on your chart. You just need 3. First is the exponential moving average. This tells you where the market is actually going over time. Second, the slow stochastic or slow sto. This shows you momentum or whether the market is overbought, oversold, or somewhere in between. Third, support and resistance levels. This shows where the buyers and sellers are most likely to act. When you combine these, you're looking at both direction and strength. This helps you filter out false signals and focus only on the setups where everything is aligned. For beginners, I recommend starting with a 34-period exponential moving average. It's also called an EMA for short, and this is for trend identification. Here's how you use these together. You're looking for a confluence zone. This is the moment where both indicators are telling you the same story. So picture this. You see the price at the 34-period exponential moving average, and it gets your attention. But if the support isn't there confirming that the buyers are there too, you're basically guessing. And that's how most people lose money. Trading without confluence is like asking for directions from only one person who might also be lost. Here's what a bullish entry looks like. You're watching your moving average and you see price testing that level. That tells you that there's support there and the trend is likely to continue upward. But you don't jump in yet. You wait. You also need to see the support confirming the move. You want to see that the support level is holding and now price is starting to turn back up. When both those things are happening together, that's your signal. The trend is continuing and the momentum is coming back from weakness. That's a high probability long setup. On the flip side, for a bearish signal, you're looking for the opposite. Price is testing the 34-period EMA from below and resistance, a resistance level. Think sellers are waiting there. And now it's reversing downward. That's your signal for a short position. The key here is confluence. You're waiting for both indicators to agree. That filters out false signals and keeps you focused on the trades that actually have a higher probability of following through. But none of this matters if you can't execute, because the biggest enemy you're going to face in trading isn't the market, it's you. Secret number 3, detach from the outcome. The market is in chaos, pure, beautiful, unpredictable chaos. And the only way to survive is to separate your ego from the outcome. So let me give you 3 psychological tools that I still use to this day. Most beginners measure success by P&L, or how much money they made today. And that's a recipe for disaster. This is because P&L fluctuates in the short term. You can follow your plan perfectly and still be losing money on a trade. So if you're measuring success by daily profits, you're measuring the wrong thing. Instead, I want you to use the STAR system. Every time you follow your trading plan and every time you execute exactly as you're supposed to, you give yourself a star, just like in grade school. But every time you break the rules, you take away 2 stars. Your goal is to get to 100 stars. This shifts your focus from outcomes you cannot control, whether the market goes up or down, to the one thing you can control, your behavior. Because long-term profitability depends on your ability to control yourself. It's about following your process consistently, trade after trade after trade. Now, if I could give you only one piece of advice for improving as a sustainable, consistently profitable trader, it would be this: journal every single trade, but not just, I bought XYZ at $50 today. Dear diary, the market was mean to me. I want you to ask yourself these 4 questions. Why did I take this trade? Did I follow my plan? If I didn't, why not? What was I feeling? This shifts accountability from the unpredictable external market to the controllable internal you. You can't control whether the market goes up or down, but you can control whether you followed your entry criteria and whether you honored your stop loss. And when you review your trades, you'll start to see patterns in your behavior. And that's where you gain your edge over your bad habits. Before I leave you, I wanted to touch on one more thing: the difference between reacting and responding. Reacting is impulsive. You feel frustrated, so you jump into a revenge trade to get back what you lost. This is how 99% of traders lose. Responding, on the other hand, is conscious. You feel frustrated, so you acknowledge it and say, I'm going to take a break before I do anything, well, stupid. Well, the best way to build that discipline is with what I call a pre-trade contract. Before you enter any trade, you'll write down 3 things: your exact entry criteria, your stop loss, and your profit target. This is similar to journaling, but we're getting really specific on numbers. The idea is that you can make these decisions when you're calm, when there's no money on the line, and you're feeling sane. Then, once the trade is live, your only job is to honor that contract. No second guessing. This front loads all the decision making to a time when you're thinking clearly, and it makes execution purely mechanical. So there you have it. 3 secrets: the 5% rule to keep you alive, the confluence strategy to find high probability entries, and the mental edge to actually execute when it matters. Remember, learning to trade is a journey. It takes time, it takes practice, and guidance from someone who's been there. So if you want to go deeper, I put together some resources for you in the description below. Thanks for watching, and if you're serious about doing trading profitably, I'll see you in this next video.